Canada met expectations this morning and announced a 0.5% or 0.5% increase to the overnight lending rate. Join me as we dive a little bit deeper and discuss exactly what this means for you and your mortgage. As has been expected for weeks now, the Bank of Canada has increased the prime rate by 0.5%, and that will move the prime rate, the bank rate that you pay your mortgage or lines of credit on, from 2.7% to 3.2%. Now, why has the Bank of Canada taken this extraordinary step of increasing 0.5%? By the way, we haven't seen a 0.5% increase to the prime rate since May of 2000. The main culprit, as you're probably aware, and you're probably sick of hearing it by now, is inflation. Of course, the recovery from COVID has caused supply chain issues, but really the cherry on top has been the conflict in Ukraine. And just a comment on the human aspects of it, it's just every day it gets worse and worse, and the human suffering is unimaginable. But it has caused spikes to fuel prices, to food prices. I'm sure you are experiencing that. And what that means is that demand is much higher than the available supply. And the only way to bring prices back down is to increase the cost of money, which would cause households like you and me, to think twice before spending discretionary money, and that's the mechanism to bring inflation back down. So the question is, by how much will the prime rate go up, and should you be locking it? Bond traders and markets, we look at bonds to determine what markets are feeling. They feel that there's another 1.5% increase to the prime rate. Although there are some observers who are a little bit more hesitant and reining in those expectations, saying, well, not so fast. These increases to the prime rate, especially this 0.5% jump, is going to have a dramatic impact on households and businesses in Canada. We're already seeing that. Real estate activity has come down in the month of March. Lumber prices, which is a good indicator of discretionary expenditure on home renovations, has come down. Expectations of fuel consumption and driving habits are changing. So the increases will have an impact on Canadians, and we may see things settle down sooner than expected, which means that the magnitude of changes of the prime rate may be more muted than markets anticipate. The second question is, if you are currently in a variable rate mortgage, should you be locking in right now? And despite the expectation of rising rates in the future, I still don't think it's viable. Why? Converting from a variable to a fixed means a very significant jump overnight to your interest rate, from sub 3% to probably over 4% at the moment. We also are anticipating in the next 24 to 36 months, the possibility of a recession as the global economy is starting to overheat and deal with these supply chain issues. It will impact businesses, it will impact households, and markets are already starting to think about recession, which would cause a decline in interest rates. So if you lock in at 4% and 2.5 years from now, the rates come back down to 3%, you'll kick yourself in that decision. I think you're better off riding the wave. My name is Chris Mulder. I am a Toronto-based mortgage broker. If you have any questions or concerns about today's announcement or what the future has in store, I'm just a phone call or an email away. Bye for now.